Thank you. Hello, everybody. Good to be back. So today I'm going to share with you my approach to directional swing and day trading using master trader technical strategies. My goal here is to give you enough complete information for you to be able to utilize this afternoon, you choose to trade, or definitely tomorrow. All right. A little bit about myself. I started in the late 80s, knew absolutely nothing. After a period of trial and error, losing money back and forth, met somebody. We started a service in 1994. We were in the right place at the right time. Internet took off. Otherwise, probably not much would have happened, and to the grand scale that it did. We had fax letters, fax machines, thermal paper, if you remember that, hotlines, the first chat room ever. There was no talking. You just had to type. Eventually, there was talking that we developed, offices around the country. We did seminars around hotels. I had a brokerage firm. Master Trader used to be a brokerage firm. And in time, I sold all the old recordings from the old company to another company. They were dying for it, basically bending over on their knees. Please, please. Okay, here you go. I used to do trading challenges. I sold the brokerage firm, took a little time off, and then decided, you know what? I own this fabulous URL domain, Master Trader. Go back and educate people and show them a better way, the light, maybe avoiding the tremendous hurdles that are out there and black holes, as I would call them, what I refer to as the indicator-based mythology. And it gets deeper from the simple to the more esoteric, Gann, Elliott wave, so on and so forth. I taught so many individuals. When we first started out, it was professionals, hedge fund managers, market makers, specialists, prop traders, so on and so forth, and just mom and pops and people like you and me, wanting to manage their own financial destiny. Some of my students have become educators in the industry. You can go to my website. I got a link on there with a whole list of them, and there's a lot more beyond that. So, all right, this is me a long time ago, guy in the middle, more hair, a few less pounds. Used to do these trader get-togethers. They still have these trader expos and money shows and so on and so forth. Haven't done one in a long time. The old company used to be called Pristine Trader Trading, Pristine Day Trader. Master Trader was the brokerage firm, and so on. And that was the booth that we had, and the title, as you can read behind me, Training, Trading, and Technology. T3 was what we coined it back in the day. So part of our process, our learning process, right? Our goal at the beginning and in the end is to make money. Right? And all of us put the cart before the horse. Right? We want to make money. We don't know what the hell we're doing. Right? And you have to have confidence, patience, and discipline. How the hell do you get there? Well, my learning process at the time was my aha moment. The light bulb went on. Take the frickin' indicators off the chart. Remove the spaghetti screen. Remove the fib lines. Remove the VWAPs. I don't even know if they had VWAP back then. Today they have some crazy stuff out there. Ichikumi clouds and so on. And focus on what matters, price. Develop a systematic, objective method to interpret that. And once you do that, okay, and you've used it for a while, remember, you're hearing from different presenters, and there are others out there doing presentations, of course. Right? You can go to one of these money shows or trader expos. But you need a systematic, objective method that you believe in, and that takes time. You have to give yourself time. And I call the learning process, as I teach it in the courses, a thought building process. I teach you how to think as a trader and to use a method that guides you to what to think right? That's what you're doing when you're in front of that screen. You're thinking, should I press the button? Is that a trade? Is it a short? Is it a long? Is it stand on, stand aside, do nothing? Is it what I'll show you as an event, that I should press the button and do something? So our goal is to create a trading plan that increases the odds of success. That's your goal. Put the odds in my favor. It's not about a short thing. It never will be. How do we do that? Well, all of these are parts of that process of building a trading plan. I say price is king. Everything else is secondary. You can't take the prices off the chart because, if you're a pattern trader, you need prices that will give you a signal what to do or do nothing. Candlestick analysis. Why? Can you use a bar chart? Absolutely. Candlesticks just create pictures that make things easier to see. No magic there. You need to have an objective method to determine the trend, retracements without Fibonacci, just common sense analysis. Multiple time frames. This is a big one. It can be very confusing because as you look at different time frames, you look at a daily chart, then you look at a weekly chart. What if you look at a 15-minute chart? The pictures change. And so as those pictures change, your thoughts change. So you need a way of interpreting multiple time frames. Support and resistance, LTTL. What is that? I've been saying this for, more than 2 decades, maybe going on 3. Look to the left. And years ago, I had a lot of guys working for me and some ladies that used to do seminars. And, as I started presenting, my way of doing things, when we first started out, we had another class, more basic anyway. And I would start telling people, look to the left. And they'd be thinking, what is he talking about? Look to the left, And so it kind of become a little bit of a, joking thing with the guys and ladies at the time. But the reality is you don't need Fibonacci levels. You don't need trader pivot lines. You don't need even a moving average, which I'm going to show you an intelligent way to do them. You don't need speed lines and all of this other stuff that leads to confusion. The support and resistance is directly to the left for you to look at. It's not hidden. There's no hidden proprietary levels. That's all hocus pocus marketing crap, okay? Volume analysis, it's secondary. I have heard all about markets have to go up or down on increasing volume. And after observing bull markets that have gone up for months, if not longer, on low volume, volume is secondary. What to pay attention to? Volume spikes catch your eye. Right? And you don't need indicators to massage the volume and tell you what it's doing. Understand what the broader markets are doing, their trend, and help create a bias. Market internals and intermarket analysis. This is part of what I call my techno-fundamental approach, 3-legged stool. Market internals tell me what's happening within the broader markets. It's a measure of that breadth and sentiment. Intermarket analysis. What are interest rates doing? What's the dollar doing? What's the price of oil doing? What are currencies doing? All of these help guide you from a longer term perspective, either long-term investing or swing trading, on where the money is likely to flow. For intraday, you can use something like an NYSE tick. It's very helpful. That's pretty much my go-to internal market gauge. Position and money management. Without that, you're not going to make it. You will not make it, because if you don't know how to manage a position and you don't know how to calculate your maximum loss through share sizing, you're going to blow up. Your goal, if you're starting out, is to last long enough to protect yourself from you. That's the bottom line. You are dangerous right now because you're trying to figure things out. And if you don't understand the money management part, it's going to be a problem. Trader psychology. Well, if you don't know money management, you're never going to get the psychology right, because it twists your head. If you put on too big a position size, the pressure there of a catastrophic loss is overwhelming. So you have to be in a position to where you can think clearly about what matters. and that is the price action. So any of these concepts doesn't create a strategy. We have to put that together to create a strategy, right? A thought building process. This top quote is something that I said years ago, and it's kind of caught on because it's the essence of what we do with technical analysis. They are pictures of others' beliefs and expectations created with money. That's what, when we look at a chart, it's not about the dark cloud cover or the piercing pattern or an Ichikume, any cloud or whatever. It's about looking at this price analysis from the point of view of what does it tell me about people's experiences? What do they believe? Are those beliefs fulfilling through, or have those beliefs been decimated, right? Like you're long XYZ, it looks like it's going to the moon and it gaps down under your support. And so you can feel that. So the price patterns create beliefs. Price patterns communicate to us how others have acted and what their beliefs and expectations are. And we can see that, as we look at the candlesticks on an ongoing basis. So let's get rid of some of this candlestick hype. You could go read websites and different books and whatever and read about engulfings and the probability or the higher percentage of a bullish counterattack versus a tweezer bottom and all of this stuff. It's not necessary. It just isn't. And as you change time frames, the candlesticks change, right? And the names changed. And so if you don't approach this from an objective point of view, this is just another layer of confusion on top of the indicators. So what matters here, and what I'm showing you here, is a 1 candle reversal, a 2 candle reversal, and a 3 candle reversal. Call them what you want, right? You can call the one with the tail, I don't know, a shooting star or a hammer. I've long forgotten the names. And the 2 candle reversal, a tweezer bottom, and the 3 candle reversal, what do they maybe call that, a morning star? Who cares? It went down and it went up. The retracement was deep from where it went down from, where it started from, where it went down to, and where it came back up to. The time frame that you are looking at will dictate what picture you see as far as candlestick names. So as I compress the data, you will get the 1 candle reversal. If I expand the data, I can get the 3 candle reversal, right? And part of what we say in our MT lives, or we look at these different pictures or patterns, is call it what you want. It says it's going to go up. Now, I have to put that in the context of other concepts that we talked about. So let's get into that. Okay. A few more candles, wide range bars, narrow range bars. How do you measure a wide range bar? Well, you just look at the chart and you say, hey, that bar is a lot bigger than the ones that preceded it. That's a big bar. And so the wide one, what we're interested in is one that on the left there, it opens at the bottom and it closes near the high, give or take a little bit, but it's a complete candle body. The body's the difference between the open and close. So it's a big green bar or a big red bar. They just jump out at you. The message is something significant happened here. If you can add some volume to it, that's all the better, but it's not necessary. If it's a big tail bar, that means it went up and it came back down. If it's got a tail on the top, you say sellers took control. Well, it can be, as you can see, the narrow ranges there. You've got some little tail bars, bottom and top. Well, we're interested in the big tail bars because big bars display emotion and commitment, and at times dashed expectations depending on where they form. As we look at that, it communicates to us momentum is slowing down, it's increasing, it's reversing. So small, narrow bodies, this slowing momentum. Big candles tell me that there's been an increase in momentum. Now let's put it in the context of the bigger picture. Now, as we start putting these candles together, right? what we're looking for is event bars. Well, what's an event? Well, we just did an MT Live a couple hours ago on tells. I don't know if you're on our email list, but we'll be sending out a recording of that probably tomorrow, I would assume. And if you get on the list, we'll send it out to you. Or you can email me if you're not and you don't get it. Anyway, so on the top there, you see these candles. And I'm just looking, forget this platform here where the drawing tools are. Here we go. All right, here you go. It attempts to go down and it springs right back up again. That's a tell, because before the green bar formed, it looked like it was going lower and it came right back up again. That communicates strong demand. And why did it go down that day? I don't know. Bad day in the market, bad day in the stock, in the sector. It went down and it sprung right back up again. Number two, it looks like this, right? Correction bars, I call them. It's a bar that takes out 1 or 2 bars lows, springs right back up again. Another picture that communicates buyers stepped up in a big way, right? Number three, here's a breakdown. And when prices break down with a range expansion red bar, it communicates prices are going to go down. It gapped up and it closed above the high. You might say, well, what the hell happened? I don't know. Maybe the trend is up and it was just a fluke kind of a day. But that's the tell. This arrangement of bars, this arrangement of bars, this arrangement of bars all communicate to me a higher probability that prices are going to follow through in the direction of the reversal. Here's a wide range bar. This one only broke the low. This is what we call a 1, a 2, and if it triggered above, that would be the 3 bar. I love these, right? Because there's a wiggle. It breaks down under the inside bars low. It comes right back up again, takes out the high, you go long. This one, you go long. This one, above the highs, you go long, so on and so forth. And the bottom is the reverse. Right? It's just upside down. All right, I remember this now. You got to turn it off. All right, multiple time frames. So the alignment of time frames or the lack thereof is what we're interested in. So we want to see the alignment of time frames in one direction puts the odds in our favor. You might say, well, why is that? Well, because the thinking behind that, the psychology behind that is that, let's just take it from an intraday trading point of view. There are traders that are trading on a 5-minute chart. There are others that trade on a 15-minute chart. Some are trading on 30-minute charts or hourly charts or what have you. Now, if all of those time frames are aligned, that means all of the traders that are utilizing those time frames independent from each other begin to have the same belief. XYZ is going to go up. Now let's apply a pattern to that belief in the time frame that we choose. Right. So they have to be aligned with your investing or trading goals. Right. If you want to hold for whatever it is for days, weeks, or months, right? Swing trading, looking at a 5-minute chart is going to be very advantageous to you. Why? Because you're going to be seeing noise that isn't aligned with what you're interested in, the higher time frames. Right? And if you're a day trader looking at a monthly chart, who cares what's going on a monthly chart? I'm a day trader. I want to know what's going to happen between, 9:30 and 4 o'clock or somewhere in between there. So swing trading, 2 to 10 days. That's what we're interested in, relatively short term. And we use the weekly for our macro time frame, giving us a bias, and the daily is for our entries. For day trading, you have to make a choice. Right? You can use any time frame you want. Right? I like using the 60-minute for my longer time frame. Where's support? Where's resistance? What's the trend? And so on. So wherever support and resistance is, I'm looking for some interaction between buyers and sellers. At that point, I want to go down to my smaller time frame and look for a picture, one of those events that are aligned with my expectations from the higher time frame. Now, sometimes things just rip. They're going so fast that a 5-minute chart doesn't form any patterns. It's just one bar after another. When I see that, I can drill down to a 2-minute. and look for that. Remember, as we expand the data, I can see more information, more pictures. I'm breaking up the same data into smaller, lower increments to see bigger pictures, right? And if it's just ripping too fast for that, just don't do anything because it ain't setting up for you at that moment, right? The analysis is the same in all time frames. Breakout, pullback, event, it all applies across all time frames. Of course, higher time frames have larger implications, but you can't look at every time frame, right? That's a path to analysis paralysis. No indicators, no proprietary systems, no special software. I don't care if you use TOS or TradeStation. I use eSignal. I use NinjaTrader. Others, there's so many platforms out there. It doesn't matter. They all create charts. Right? There's no best time frame. Already said that. Here is your plan, part of your plan, right? Macro time frame. So I just draw a line. It's going up, right? We already covered time frames for day trading and swing trading. And so now the general focus is that it's going up. Micro time frame. Well, I'm looking for support. I'm looking for resistance. So it's trending. Sometimes it goes sideways and goes higher, of course, but we're looking to align our bias with a higher time frame and then go to a smaller time frame, pulling back. Simple concept. What was, you've heard this probably 100 times, what was resistance becomes support. So as prices go through that, our expectation is that as it pulls back to that level, there'll be buyers there. If it pulls back down to the prior swing low, there'll be buyers there. And we just continue that process. And over here, the way I drew this, and you don't need any indicators. One of the ways we read increasing and slowing momentum is the distance between highs like this. When you have strong momentum, you exceed the prior high by a relatively substantial amount. Whereas if it pulls back and it only marginally exceeds the prior high, momentum is slowing. It's common sense. And those that use, whether it's RSI or stochastics or ultimate indicator, oscillator, blah, 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 they'll show you the bearish divergence, and then 20/20 hindsight, you'll see how it went down. Slowing momentum doesn't violate the trend. It's got to break below the prior swing low to violate the trend. Draw this. All right. So how do we use moving averages intelligently? Many, many years ago, I took everything off the chart. No moving averages, no lines of any kind. Horizontal lines connecting the whole numbers and half numbers. Oh, that was such a worry. It'll stop at the horizontal line. It'll stop at this, it'll stop at that. Eventually it was like, oh, there's so many things it could stop at. You couldn't do anything. Right? So as time passed by, I was like, okay, I think a couple of moving averages could help speed things up if I use them intelligently. Right? That's what I have coined a visual aid. I use simple moving averages, no exponential, no weighted, no triangular, no optimized, just regular old simple moving average. They're not really support or resistance moving averages. Some will say this moving average is support, and if I optimize it, it works better. Don't get caught up in that. Right? It becomes a self-fulfilling prophecy. On an index, the majority are looking at a 50 MA or a 200 MA, maybe a 100. Right? It doesn't matter. I like to use the 50 and the 200 and the 20 on a daily. Because they become a self-fulfilling prophecy, and it tells me about multiple time frames, which I'll explain. Okay. Let's look at that. So this was something that I found to be very helpful, rather than looking at a moving average. And as I change time frames, of course, the moving averages have to change from where they were before because you changed the time frame. So now, if you believe a 50 MA on the daily chart is support, should you believe the 50 MA on a 5-minute chart is support? I don't think so, because it just doesn't work that way. And then as you start seeing prices slicing through moving averages like they're not there, you start questioning, maybe you're not using the right ones. There's a lot of traps in this business. There's so many traps related to indicators and settings and so on. So as it says, you need to calculate the number of bars in your lower time frame that make up a higher. How many daily bars are in a weekly time frame? Most weeks 5. On a shortened holiday week, it's 4. So we'll just deal with that. The difference, we don't need to be perfect. We don't need perfection. Right? And so when you figure that, right, you multiply the number by the moving average in the higher time frame, and that's your MA, moving average on a lower time frame. So I call them smart moving averages. And here I'm just doing the calculation just to show you an example. Right? Weekly 10 MA, same as the 50 on the daily. There's the calculation. Right? So if you put a 20 MA on your weekly time frame, it's the same as the 100 MA on the daily. So if you look at your weekly chart with a 20 MA, you know where the 100 MA is on the daily time frame. And for your intraday charts, right, 60 MA, what's the 20 MA? Do the calculation, 240 on the 5, 12 bars times 20, 240. I just put the 200. It's close enough for the government work, right, which is pretty sloppy, as we know. Right, 15-minute chart, 20 MA, same as the 60 on a 5, 3 bars times 20. I put a 60 MA on my 5-minute chart. Now I know where the 20 MA is on the 15-minute chart. Do I really care where the 20 MA is on the 15-minute chart? No. What I'm interested in is what is the trend on the 15-minute chart? Because the traders that are trading the 15-minute chart in an uptrend are going to be buyers. In a downtrend, they're going to be sellers or shorting. Right? And so I'm looking for on a 5-minute chart the alignment of the 5, the 15, and the 60 by just looking at the 5-minute chart. Do I have alignment of those moving averages? It's simple and it works. Now, what are we looking for? This is what explains, and we can capture this and send it to you. And you're going to get the recording. What we're looking for, putting together a little trading plan here. Right? 20 MA is above the 50 on the daily time frame, so it's in an uptrend on the daily and weekly time frame because the 50 is the same as the 10, right, on the weekly. So if the 50 is going up and the 20 is going up or down, those two time frames are aligned in the same direction. Right? I want to see prices close to these moving averages possible. The moving averages close to each other and prices close to the 20 MA, maybe touching. Right? The prices had to be preceded by a momentum move, some strength that suggests the continuation of that strength. And then there's going to be those event bars that we looked at. Is there a void? Well, I didn't tell you what a void is yet, but a void is just the word says, void. Void of what? Support or resistance, right? Today, there's a void under the markets. Why? Because they gapped up a tremendous amount. It's a void. There's no price data to the left. The 5-minute, as I explained, 20 and 60s, right? 200, if it's aligned, not always necessary, but optimal. And then I want to see prices intraday above today's open and above yesterday's close. Why? Because the daily candle is then, the body is green. If you color them green and red, it's above the open, it's above yesterday's close, green candle. Buyers are in control. And prices are well below, right, for sure, it's well below the open and yesterday's close. And a lot of these setups set up right after 2 o'clock, many times at 2:15. And for shorts, you just turn it upside down. Right? So let's look at some examples. Right? Prices are trending down, spike up through the moving averages, through the pivots. These pivots, these dots here, are defined as a bar with 3 lower highs to the left and right, bottom ones, 3 higher lows to the left and right. Nothing magical about that. Your software probably calls them fractals. I don't know why, but they do. Momentum move up, pulls back to the moving averages. Bottoming tail bar. That was a red bar. Here's a red bar. It's going sideways. Think long. Another one, 5-minute chart. Momentum move higher. This is just, the technical term is a mess. Overlapping big bars, like just a big mess. Now, topping tail. It got rejected when it went up. Maybe it's going to go down. Right, come back up again, break down. Maybe it's going to go down, and it comes back up again. And now here, your moving averages are together. Right, it's above yesterday's close and above the open, so it's up on the day. It's in the afternoon, and now you get a wide range igniting bar. Buy it. Stop below here. Then you get a little one. Here's your 1, 2, right, 3 igniting, and it's moving up. But it's built this big base. A lot of these moves happen after 2 o'clock. Right? Here's another one. Right? Big strong move creates a void. Right? This is the example of a void. Right? It ripped higher. There's nothing to the left. It forms a pivot. That's new support. Pivot, support, higher support, higher support, higher support, higher support. Pinched moving averages. It's after 2 o'clock. Get ready. Buy that, buy the pullback, buy above these highs. Right? So you don't always have to get the first entry. If you can, fantastic. But many times there's some kind of new setup, pullbacks, consolidations. Look at this bar right here. It takes out the lows and pops back up again. That's an ad. You got into the rest of the day. Right? Another 5-minute chart. Right? Big strong move up, pullback 215, red bar, immediate reversal, what we call a 180. Put a buy above the highs. I'm not telling you they're all going to act like this. Right? Some days it'll pop up and you'll get a pullback pattern or a sideways pattern. The honest answer is you don't know which ones are going to work and which don't. It's an odds thing, and how they react each time is an unknown. Right? Sometimes they're going to explode and you're going to be happy as hell. Sometimes they're going to stall and you're going to, oh, is this one going to stop me out? You don't know. Is it going to pull back? Will buyers be there on the pullback? You don't know. You just watch the bars, what I call bar by bar analysis. All right. Another example and a tell. This is what we call a downside shakeout. I explained this in detail in MT Live this today. Sideways, breakdown, immediate reversal, violent reversal right back up again, and sideways again at resistance. Pretty tight. Now this bar, that's a tell. Why is that a tell? It gapped below all of these bars and it closed near the high. Buyers were down below there and they scooped it up and drove it higher. Who did that? Institutions. They were sitting there. Why did they buy the gap down? Because it not appeared, it was bearish. It gapped down there because they don't care. They just said it's cheaper than it was yesterday and they want to buy it. They created this move up. Where's the big volume spike? Oh, geez, there is none. There's no big volume spike. So you don't need there to be. But look at these volume spikes. When it gapped down that day, oh, geez, it gapped down under the base on big volume. That's bearish. I would agree. Well, what the hell's going on over here? Why doesn't it keep going down? Well, somebody doesn't think it's so bearish. They're accumulating. And then they ripped it back up again. And notice how the bars overlap each other very little. It opens up near the prior bar's closer, it gaps up and it goes higher, and it hits the resistance area, and it begins to stall. Well, there's the tell, there's the setup. Our job is to find these setups, and that's why, we use scanning software to find this stuff. These boxes here are actual trades from one of our letters, either the, could be the swing and options trader, could be the weekly options trader. You can see, what it says here. Bought a half lot, so it was long. Sometimes we don't go all in, depending on the setup. Wide range bar breakout. Here's the breakout there. And, we give you the entry, the stop, how to manage it. We send text messages to you, besides there's a letter every weekend, extensive analysis and videos, and there's videos every night to update trades. But see the star there, this red bar, there's your event right there, reversal, and then your breakout. So we're just looking at a few others here as we go through these. Swing and options trader, explaining the setup, explaining the management, logging out of the trade, not logging, taking partial profits and so on. All of this is updated in the member area and through text messaging, and then new trades at the end of the day. You get a video at the end of the night, but the trades are sent to you via text message during the week through texting, where we send you a chart and explain everything. And as you learn the method, you know exactly why you're doing stuff. And you can see the management there. Made 29.25 points in 10 days. There's the gain on 100 shares. Used a covered call at the time as it got extended. So we do a lot of option trades as well as just, long and short and puts and calls and credit spreads. So we do a lot. Another example, a bear put debit spread. You might say, what's that? Well, you buy one option, you sell another option, you help fund the trade, and it costs you a little money, a little less than just buying the put, and you take advantage as it's moving lower. There's the management. Again, the reason why we're doing, we always tell you why we're doing it. We're not just telling you, hey, Master Trader said buy XYZ or do this option thing. No, it's about education every single day, whether it's in the letter, whether it's in the green room, our chat room, we're educating every single day. Right? So there, the stars marking off the 1, 2, 3 continuation pattern after the gap down from that retracement. Another example, swing and option trader letter. That big rounding top pointing out this bearish, wide, nasty red bar with the arrow pointing to it, the failed little buy setup, which was that pullback right here. This little pullback right there fails, and it breaks all of these lows. And so here, it's trying to retrace, it's trying to rebuild, and it gaps down, big, wide range, bearish bar, breaking the lows. And it gave us a 1, 2, 3 continuation pattern. We take the trade, put a stop up here and go into management mode. And, we tell you along the way how to manage, lower your stop, cover half, take some money off the table. This is a layout in the software that we use, things that I've created, this and other layouts. And this is for what I refer to and others would refer to as a top-down approach of looking at the broader markets, big indices, the S&P sectors, ETFs that I focus on, industry groups, and I sort these looking for the wide range bars, a percentage gain on the week, on the day, a few other things. These are scans within the layout, topping tails and bottoming tail bars. This one's a topping tail that took out a prior high. So there was a little failure there, weekly wide range bars. And so as I click any of these, it loads the stocks within that index or that sector in here. And now I can start clicking this and start looking for, hey, is this thing touching the 50, the 200 MA, the 50 MA, the 20 MA? Was there a breakout, a breakdown? Was there a 180 reversal? Is there a 1, 2, 3? And by clicking these, it now sorts that column by what we're looking for. So if I see that, say, for example, I don't know, regional banks look interesting for whatever, I click this, it loads it in my charts. Now I go in here and I sort this by percentage gain on the day, the week, as I explained, what's done well, what's done poorly, and I start looking for setups for what I've explained to find opportunities to do option trades or directional trades. I'm primarily looking for directional trades. I mentioned MT Live. All right, we did one today on tells. I said we'll be sending out a recording of that, I think by tomorrow. Sometimes we do, options. We do not volume. I don't think we ever do just focus on volume, but support, resistance, trend analysis, many different individual subjects that encompass the whole course. And so you can go to the YouTube channel. There it is, youtube.com/C/. Master Trader, but we're on Facebook. You can look for Master Trader. We're on Twitter or X, and all of those presentations, pre-market reviews, and the MT Lives are there live at those times during the day, 9 o'clock in the morning, 12 o'clock to 1 o'clock on Wednesdays, right? Today, get started with MT Live. This offer, top-down approach course to the markets. Basically, what I've been talking about, but giving you an overview. And if you know nothing, this is a great way to start out, right? Getting familiar with how we do things, the top-down approach, and then the technical analysis part, an intro to options, learning that, then 9 months of weekly lessons, a lesson on a different topic that comes into your inbox every week for 9 months. After 9 months, it stops. You know, if that, you've either signed up for maybe the swing trading course or an option course, you're in the green room, you're learning more, you're on the way. But for now, you're in a learning process, you're getting familiar with Master Trader. And with that, it's offered today, 3 months of the swing and advisory letter. And you can go to the website and read details of what that encompasses. It's a tremendous amount of information and education. 3 months of the weekly options trader. As I said, weekly options trade, income trades, virtually every day. We have option trades. Some option traders say, oh, you know, we give you 2 trades a week. No, we're giving you trades almost every single day for, you know, income trading strategies with weekly options. The swing and options letter is more focused on swing trades, debit spreads, some credit spreads, but looking to hold things for a little bit longer. Coaching we do each month. You get that for life, even if you're not a subscriber after that. Once you're with us, you're with us. My scans and layouts, they come with your membership. And there's the offer today. For me, it's a no-brainer. For $197, you are learning over the course with the letters and that course for at least 9 months. The majority of people continue after that. You continue to get the coaching regardless of what you do. The scans are yours to keep if you use TC2000. There's nothing on there that stops your connection if you're not a subscriber anymore. And we're available, you know, as far as email help with your trades. You got a question, you know, was I looking at this correctly? But, you know, if you join the green room, which you can do a $7 trial for the week, you know, tremendous amount of education. I think I've hit my time limit, maybe exactly.
Hey, I have the link. Greg's offer right there in the chat.
Yeah.
I want to thank Greg for joining us. And again,
Yeah,
you'll get
the chat
the link a few hours later.
Yeah. Or you could just type in what I had on the bottom there, mastertrader.com/June deal, and that'll take you to the link as well. So you can just remember June deal, and you can get to it if maybe you want to do it, you know, later tonight or tomorrow, what have you.